In this presentation, we will take a look at the journal entries for a practice problem where we have one company that's going to be creating a subsidiary, a fully owned subsidiary. So we have one company, that company is going to break off some of its assets and liability, create another company, which will be fully owned by what will be now the parent company owning the subsidiary company. Get ready to account with advanced financial accounting. Here is the data that we will use in our practice problem. So we have P creates S, a 100% owned subsidiary. So these are going to be the two entities involved. P is going to be the parent company that's going to be the original company. So we started with just one company in this case that created another company, which we're going to call S. Now we're going to be using this P and S for many of our example type problems. P is usually standing for the parent company, but it's just a company name. P, S, often standing for the subsidiary company, but again, it's just a company name. Now, in this case, we're going to be creating a subsidiary. Later on, we'll actually take a look at situations where there's going to be a purchase type of process or an acquisition, and we're still going to be using basically P and S. So these are the company names that are going to help you to remember that the P is basically the parent typically in this case, and S is going to be like the subsidiary, or often in other situations, the company that's going to be acquired typically. So P creates S, a 100% subsidiary. P balance sheet before and after the transactions are below. That's going to be over here. So this is the parent's balance sheet, the original company's balance sheet before and after this transaction. Then what happens is P is going to transfer to S assets and liabilities, and S is going to give in exchange the equity value, which is going to be the shares, at a par value of 10. So we'll take a look at the journal entries that P is going to make for this transaction and the journal entries that S is going to make for this transaction. Now, you want to have a distinction in your mind thinking about these types of problems, and I would think of it in terms of, hey, are there two people involved, or is this basically just one entity that's restructuring? If in this case, it's basically one entity that's basically now kind of restructuring, making two entities out of one original entity. That means it's not like an acquisition. It's not like the S didn't exist before P made it. And therefore, there's no kind of negotiation process that happens. There's no kind of purchasing type of thing that's happening. No exchange, no market exchange. Therefore, we're typically not going to have to revalue the assets basically from a book method to a fair value method. Whereas if it was two entities involved, if there's kind of some kind of sale acquisition type of thing happening, then you would think that the regulations would want you to revalue to the fair market value at that point in time and recognize it more as you would for a sale and a purchase situation. So in this case, we don't really have a sale or purchase situation. We have P saying, hey, I'd like to restructure for whatever reason and make another company, which will be fully owned by the original company, P, that company being S. So what we're going to do is we're just going to create this new company. We're going to transfer assets and liabilities into it in exchange for the equity in S. So that's going to be our objective. Now we're going to start off here with a problem where we have the information before and after. So we've already done this. We're imagining the transaction already took place. This is where we stood before. This is where we stood after. And what we'll do is we'll kind of back in then to what the journal entry was to get from here to there. So we'll deconstruct this, and then we'll go back in and we'll reconstruct it. Then we'll post the journal entry back out again so you can see it kind of both ways, from a deconstruction and a reconstruction. So in other words, this has already happened. This is P's information before and after. So these are the assets and the liabilities and equity before and after. Okay, so first thing we're going to do is take the difference between the before and after, right? So we're going to say, all right, what's the difference between these columns? Well, we have cash. Was this before? It was this after. That's a difference of 41,000. That means that we transferred cash to S of 41,000, right? Accounts receivable, 83 before, 32 right after. That means we must have transferred to S 51,000 of accounts receivable. 41,000 in other assets, left 18,000. We transferred 23,000 there. Then the investment, this is going to be an account that we're going to have to create as we go through this process. Land, it looks like we transferred the 1,000 here. We got the building and equipment. We transferred the 72 here. Note that when we have this transfer process where it's not a purchase kind of thing happening, but the creation of another subsidiary, then we're transferring at the book value, and therefore we're still going to be transferring, say, the accumulated depreciation as well. So we're transferring the building and the equipment and the book value related to it. Also note that in practice, this kind of restructure is not too difficult for most of the accounts, because if you were to do this, if you thought about this transaction, you can say, all right, I'm one company, I'm going to make another company because I think it'll be beneficial for whatever reason to have that restructure. All right, well, I'm just going to transfer over 41,000 of cash. I'm going to transfer over the accounts receivable 51,000, other assets of the 23, land of the 1,000. Now, land and building get a little bit more tricky, because you do have to have the supporting schedules to say, hey, which land and equipment and building are you transferring over there, and what are the related depreciation schedules, both for the book depreciation and tax depreciation, and what other type of depreciation methods you need to be using for the books and taxes and whatnot. So that gets a little bit more tricky, but more straightforward, possibly than some other kind of reorganizations, right? So we're going to transfer over the building and the equipment, the accumulated depreciation and so forth, and then on the accounts payable, looks like we transferred over 21,000 of the accounts payable, and it looks like that's going to be it. So now we took the difference here. So we have our difference column. Now that we have the difference, we're going to reconstruct what must have been the journal entry to get us then from the before to the after. Well, this must be the journal entry. In essence, this is basically the journal entry. Let's put it in journal entry form. Now, as we created the journal entries, I'm not going to be putting the debits on top necessarily. I'm going to be putting this in the format that's easiest for us to construct, easy to build. And so just keep that in mind. If you want to then put it in debits on top, credits on bottom order for purposes of presentation, you can do so. But even in practice, I would put it in a way that makes the most sense if possible, because if I go back to this in 5 years, I don't care that it looks like nice, the debits are on top. I want to know if I want to reconstruct this thing in my mind, and I want to put it together in a way that's easiest for me to reconstruct in my mind. So how would we do this? I'm going to say, all right, cash, the cash must have gone out, because if we're talking about P's books here, so on P's books, we must have credited cash, 41,000, because we transferred it from P to S. So we're talking about P's books, we must have transferred the 41. The accounts receivable, well, that must be going down on P's books because we transferred it to S of the 51,000. We transferred other assets of the 23,000. And then I'm skipping this one for now. We'll be back here later. And then the land we transferred at 1,000. The building we transferred at the 72,000. And then the accumulated depreciation, which is a contra asset account. It has a credit balance, in other words, and we're making it go down. So we're doing the opposite thing, which is a debit. And then we're going to say that the accounts payable is going down. It has a credit balance, and so we're making it go down, which is the opposite thing, which is a debit. All right, and so then if you think about where we stand at this point, we can obviously say, all right, well, what did we transfer in? We transferred 41,000, pulling out the trusty calculator, plus 51,000, plus the 23,000, plus 1,000, plus 72,000, and then we had minus the 44,000 minus the 21,000. That leaves us with the 123,000. So, and that's what we need to be in balance too, credits minus the debits. Where are we going to put that? Where does that 123,000 fall into play here? We're going to put that in an investment in S company, because we're going to transfer to S company. We fully own S company. Therefore, we're going to represent on one line item, just say, hey, we have net worth, in essence, on a book value method, because we didn't fair value this thing. We got a net worth of the 123,000 that's in this other company that we just made, which is S's company. When we make S company, will result in an equity section in S, which will be equivalent to 123,000 because we fully own S, and the assets minus the liabilities equals the equity section, which will represent the net assets that we just transferred over, which is these assets minus these liabilities, which will be the 123,000 represented by that equity section. Let's take a look at that then. So let's post this out first. If we post this, this are the beginning balance numbers, and you'll recall if we go back to like the original data here now, we had the beginning before numbers and then the after numbers, and now we've deconstructed this to see what the journal entry is. Now we're going to reconstruct. In other words, we're going to take these numbers here, the before numbers, and just post the journal entry to get back to the after numbers. So we've deconstructed it. Now let's reconstruct it. We've got the journal entry. Now we've made the journal entry. Let's post out the journal entry here. Here are the beginning numbers. If we were to post this, we'd say, all right, and this is how easy the thought process might be just in general when you're just kind of looking over this. You say, oh, 63,000, I'm going to make another S company, so let's transfer out the 41,000. That will leave us with 22,000 in cash. Let's transfer out the receivable. I'm just posting this journal entry over here. Of the 51,000, which would leave us in the parent company 32,000. Let's transfer out the other assets of the 23,000, leaving us with 18,000. And I'm going to go down, we're skipping down to land here. Let's transfer out the land at the 1,000, leaving us with 17,000. We'll transfer out the building and equipment, 72,000, leaving us with 107,000. And then the related accumulated depreciation going down. This is a contra asset account, has a credit balance, goes down by doing the opposite thing to it, a debit. Then we have the accounts payable. So the accounts payable is a credit balance account. We're going to debit it to make it go down as well. And then the difference is going to be reflected at that 123,000. So there's the 123,000 that we're going to have. So now we're going to create our another company. That's where this is going to go to. It's going to go into the other company. The equity section is going to match this amount, the 123, because it's a 100% fully owned subsidiary company. All right, so now let's take a look at that. So we're going to take the same data now and we're going to reconstruct this thing, this time for the new company, the subsidiary. And this journal entry will, of course, look very similar, but it's going to be the opposite kind of situation. And instead of us resulting in this account here, we're going to have an equity section that's going to result in that 123,000. So I'm going to use the same data, the before and after. This is the before and after for P company. We're kind of deconstructing now to what was the journal entry to create S. So we're going to use the same information. I'm going to say, all right, this is going to be the new company that we're making S company, the subsidiary, the new S company that came out of nowhere now. We're going to say, all right, it's going to have on the books cash. Now debiting, increasing cash, 41,000. We're going to increase the receivable by the 51,000. We're going to increase with a debit the other assets, 23,000. We are going to have land of 1,000. We're going to have then the building and equipment, 72,000, the related accumulated depreciation, the 44,000, and then we're going to have the accounts payable going on the books at the 21,000. That's increasing in the credit direction here. And then instead of us having the difference now we got the same thing, but now the debits are greater than the credits by that 123,000. Now we need to basically take the figure out what the equity, the difference here is going to be the equity section. So that 123 is going to go into equity. But it's a little bit more confusing than that because we need the equity to break out between the par value and the additional paid in capital. So we just need to know what the par value is and then break it out between the par and the additional paid in capital. So if we go back up top to our data, we're going to say, all right, we had the P is going to have $10 par value stock, right? $10 par value stock. So let's go on back down here to our information. So the amount of stock that we're going to issue, and remember that the par value is kind of an arbitrary number. I'm going to pull out the giant calculator here. I'll make it a little smaller. And then we're going to say that we had $10 times 4,900 shares or 49,000, right? 49,000 of the common stock, and the difference goes into additional paid in capital. So that's going to be basically the plug, because remember the cash minus the liabilities here that we transferred add up to that 123,000. So I can then take the 123,000 minus the 49,000. And that'll be the 74,000. So in other words, we know that this amount here, the assets minus the liabilities and the contra asset, add up to that 123,000. 123,000, that difference is going to go into equity. But we have to break it out just like we did, and we have a corporate accounting class if you want to look at, how to issue the stock and whatnot. But it's a similar process here. It's the same process where we're just going to say the common stock is going to be on that par value. Par value is going to be a set rate. It's not related to the market rate. So we're going to say just here's the par value, 49,000. Then the difference between the 123 that got transferred in and that par value is just going to go into the additional paid in capital, in this case being the 74,000. So you'll see that this 49,000 plus the 74,000, if we pull out the trusty calculator, will of course equal that 123, I believe. So the 49,000 plus the 74,000 now equaling that 123,000. All right. So then if we were to post this, we have a fresh company here that has nothing in it thus far. Here's the journal entry. This is the S. This is the new company that's being created. Second company, new company being created. We're just going to say, all right, we're just going to debit. The cash is going to go up by the 41,000. The accounts receivable by 51,000. The other assets, we're just putting this information into the empty shell, the land, the building and equipment, then the related accumulated depreciation, the accounts payable, and then the common stock, the additional paid in capital. So, and then there it is. So now we've just created our subsidiary. We broke out the parent company and created the subsidiary. So now here's the parent company after this has taken place, and here's the subsidiary after this has taken place. And of course, we can see that on the parent company, we have the $123,000 in the investment in S company is going to be reflected because we own 100% of the new company we made. We just broke it out. Is going to be reflected here by the $49,000 and the $74,000, which is equity. And remember, if you think about equity, of course, it means assets minus liability equals the equity. You can also think of equity as kind of like a liability because the liability represents what the company, a separate legal entity, owes to somebody else. In the case of a liability, a third party. In the case of the common stock, what it owes to the owners being 100% owned by another company, that company being P, right? So that's what it's going to be represented as over here. You can also think of it as two sides of the coin. You're going to say, well, the assets represent, assets that are held by the company, and then who has claim to those assets? Well, you've got the third-party people, and that's going to be the liabilities, and then the owners. And again, the only owners, 100% owned, is going to be the parent company, and therefore the investment in S company over here is reflecting the equity section on this side, the $49,000 and the $74,000 equaling the $123,000.